So in 2018, the Tax Cuts and Jobs Act dramatically changed the charitable giving landscape here in the United States. By doubling the standard deduction, it gave people much less of a motivation to itemize their charitable contributions. And the upshot of this was a lot of charities suffered and still haven't recovered yet from that change. So what I hope to do in today's video is give you 3 ways that you can potentially use to give not only to your charity, but also potentially benefit your tax bill. Now, a quick disclaimer. All 3 of these strategies do require you to itemize on your taxes, but my hope is that at the end of this video, you'll be able to make a better informed decision about whether this is indeed a year where you can itemize when you take into account these different strategies. So, first one, charitable mileage. The IRS delineated 14 cents per mile in 1998, and unfortunately it hasn't changed since, that you can deduct when you're on charitable business. So let's say you're driving to a church event you're volunteering at, or it could be a Rotary event perhaps. It could be anything. As long as it's connected to a 501c3, you can deduct the mileage that you're driving. That 14 cents a mile is going to take a while to add up, but let's say you're doing this regularly, it can add up to the point where maybe this is the year where you trip that line and decide, hey, it makes sense to itemize. Number 2, appreciated stock. Now this doesn't have to be stock specifically, but a lot of people, hold stock and it makes sense. It could be real estate, it could be an asset, even from your business, for instance. Quick disclaimer, you will want to make sure that if it's from your business, you're taking into account your entity structure. C Corp versus S Corp makes a difference how you can deduct that. However, if you have, let's say, $20,000 that you plan to give to charity this year, and you also have a position in your portfolio that has done really well, but you probably shouldn't hold that much of it right now, and you're looking at trimming that, but you don't want to get killed in taxes, it might make more sense to, instead of giving that $20,000 in cash, consider giving a portion or all of that appreciated stock to charity. And if your charity isn't set up to receive that when you talk to them, have them talk to us. We can do that. It's a very simple process and we can guide them through it. Number 3, a donor-advised fund. So this is something that admittedly is going to make a little bit more sense if you're a little further into your career and you're having a lot of income coming in. Let's say maybe it's a higher than normal income year. Perhaps you sold an asset or your business, your practice, for instance. And now you're considering, what's something I can do to bunch my contributions into one year, this year where I have a high tax bill? This is where the donor advised fund comes in. This is a way that you can bunch up contributions, if you will, for the next however many years you want. You can put a significant sum of money into the donor advised fund, and it counts as a charitable contribution, subject to certain limitations, of course, but you don't have to give it all to charity this year. From the donor advised fund, you can then dole out set amounts each year to the charity or charities of your choice, and you get the deduction in the year that you put the money in the donor advised fund. And these days, donor advised funds have very low minimums. For instance, $5,000 is the one that I use for my clients. You can use this as a tool in pretty much any year, but again, it makes more sense in higher tax years rather than lower tax years. So those were 3 quick hits on how you could potentially use your charitable giving to not only impact the charity, but also your tax bill. So if you have questions about any of these, or you're wondering, hey, is this a good fit for me? Give us a call. We're happy to have a conversation. Drop us a line here. Happy to talk. And in the meantime, we'll see you out there.